Right now, something very important is happening in the gold and silver market, and most people are completely missing it. Just a few days ago, gold looked weak, almost like it was losing strength. Many traders were starting to panic, thinking the rally was over. But then suddenly, the market flipped. Gold bounced hard, silver followed, and within days, we saw a powerful move that surprised almost everyone. This kind of sharp reversal is not normal. It usually means one thing. Smart money is stepping in quietly before a much bigger move. Welcome to Gold Silver Scope, where we break down what's really happening behind the headlines in simple and clear language so you can understand the real story. Now let's look at what actually happened. Gold dropped earlier in the week and touched a low level, but that drop did not last long. Instead of continuing down, it quickly reversed and started climbing. Within a short time, gold moved up strongly, showing a powerful recovery. Even after a small pullback later, gold still closed the week with solid gains. This tells us that buyers are still active and confident. When a market falls and then quickly recovers like this, it usually means the downside is limited and the trend is trying to move higher. Silver also showed strength. In fact, silver performed even better in percentage terms. It moved higher and closed the week strong. This is important because silver often acts as a high-energy version of gold. When silver starts outperforming, it can signal that momentum is building in the entire precious metals sector. But what's even more interesting is what happened with mining stocks. Gold and silver mining companies saw very strong gains in just a few days. These stocks usually move faster than the metals themselves. So when they start rising sharply, it often means investors are expecting higher prices ahead. Even though there was a small drop later in the week, the overall performance was still very strong. This kind of behavior suggests that the market is positioning for something bigger. Now compare this with the stock market. Major indexes like the Dow, S&P 500, and Nasdaq did go up slightly, but their gains were much smaller compared to gold, silver, and mining stocks. This difference is very important. It shows that money may slowly be shifting from traditional assets into hard assets like gold and silver. When this shift begins, it doesn't happen all at once. It starts quietly, and only later does the crowd notice. Another key point is the bigger picture. Even though gold had a weak period recently, it is still performing well overall. Sometimes markets need to correct before they move higher again. A strong drop can actually create the foundation for a bigger rally, and right now, it looks like that foundation may already be in place. There is also a strong possibility that the current month could turn out to be very important for gold. After a weak phase, markets often move in the opposite direction with strong momentum. If that happens, we could see a powerful upward move that catches many people off guard. This is exactly how major trends begin. Quietly at first, then suddenly accelerating. So what we are seeing right now is not just a normal bounce. It could be the early stage of a much bigger move. The market is giving signals, but only those who are paying attention will understand them. Now let's go deeper into the real force behind this move. And this is where most people get it completely wrong. Everyone is focused on what the Federal Reserve is doing. Traders keep asking, will the Fed cut rates, hold rates, or raise rates? And based on that, they try to predict gold and silver. But this way of thinking is too simple. And honestly, it's misleading. The truth is, gold does not care about just interest rates. What really matters is something called real interest rates. This is the difference between interest rates and inflation. And right now, inflation is rising faster than most people realize. That means even if the Fed keeps rates high, or even raises them slightly, it doesn't actually make money stronger. In reality, it can make money weaker. Let's understand this in a simple way. Imagine the Fed keeps interest rates at 5%, but inflation is running at 7% or even higher in real life. That means your money is still losing value every year. So even though rates look high on paper, in reality, they are still negative after inflation. And this is exactly the kind of environment where gold and silver perform the best. This is the big mistake most traders are making right now. They think that if the Fed stays strict, gold should fall. But history shows the opposite. When inflation rises and real rates go down, gold goes up, even if the Fed sounds aggressive. Now let's add another important factor: rising commodity prices. Oil prices have been moving higher, and this is creating pressure across the entire economy. When oil goes up, transportation becomes expensive, production costs increase, and eventually everything becomes more expensive, from food to basic goods. This feeds directly into inflation, and we are already starting to see this effect. Food prices are rising, daily living costs are increasing, and people are feeling the pressure. Even basic items like coffee, grains, and other commodities are becoming more expensive. This is not temporary. This is part of a larger trend. But here's where things get even more interesting. As inflation rises and the economy starts to slow down because of higher costs, governments and central banks come under pressure. They cannot allow the economy to weaken too much. So what do? They prepare for stimulus. This is the cycle. First inflation rises, then growth slows, and then stimulus comes in. And stimulus means more money printing, more liquidity, and more currency devaluation. And every time this cycle repeats, gold and silver benefit. So even if the Fed is not cutting rates right now, the market is already looking ahead. Investors are starting to price in what will happen next, and that is more support, more easing, and more money entering the system. This is why gold is not falling. In fact, it is preparing to move higher. Another important point is government spending. Budget deficits are increasing, and large amounts of money are being borrowed. This puts pressure on the financial system. When governments spend more than they earn, they need to finance that gap. And often, that leads to more money creation. At the same time, higher borrowing leads to higher yields and higher interest costs. This creates stress in the economy. Mortgage rates rise, business costs increase, and overall growth slows down. When that happens, the system becomes unstable. And that is when investors start moving towards safe assets like gold and silver. So what we are seeing right now is not just a short-term move. It is part of a bigger shift. Inflation is rising, real rates are falling, economic pressure is building, and the system is moving closer to another round of stimulus. And when all these factors come together, gold and silver don't just move slowly, they can move very fast. Now let's connect everything with what's happening globally, because this is where the situation becomes even more interesting and a bit unusual. Right now, markets are not behaving in the way they normally do. In fact, many assets are moving together based on one key factor: oil prices. If you look closely, you'll notice a strange pattern. When oil prices go up, most other assets, including stocks, bonds, and even sometimes gold, start reacting negatively. And when oil goes down, those same markets start moving higher again. This kind of synchronized movement is not normal in the long term, but it tells us something important about what investors are thinking right now. The reason behind this is simple. Rising oil prices are being seen as a sign of increasing global tension and economic pressure. Higher oil means higher costs everywhere: transportation, production, and daily living. And because of this, investors believe that central banks, especially the Federal Reserve, will be forced to stay cautious. Right now, the market believes that as long as oil stays high, the Fed will hesitate to cut interest rates. Even if economic data starts showing weakness, the fear of inflation will keep the Fed from acting quickly. This creates a kind of pause mode in the market, where investors are unsure about the next big move. But here's the key insight. This relationship is temporary and misleading. Because while oil prices may delay decisions, They actually increase long-term pressure on the system. The longer oil stays high, the more damage it does to the economy. Businesses face higher costs, consumers spend less, and growth starts slowing down. This builds pressure on policymakers, and eventually, they are forced to respond. And when that response comes, it usually comes fast and strong. This is where gold and silver come back into focus. Even if they move sideways or react temporarily with other assets, their long-term direction is driven by deeper forces, like currency weakness, inflation, and financial instability. These forces are already building in the background. Another important point is bond yields. Recently, yields have remained relatively high. This might look like a negative signal for gold at first, because traditionally, higher yields can compete with gold. But again, this is where most people misunderstand the situation. High yields in today's environment are not a sign of strength. They are a sign of stress. When yields rise because of strong economic growth, that's one thing. But when yields stay high while the economy is weakening and deficits are rising, that's a warning signal. It means the system is under pressure, and in such conditions, gold does not fall. It prepares for a stronger move. The same goes for the dollar. Many expected the dollar to become stronger due to tight policies and global uncertainty. But the reality is different. The dollar has not shown strong, consistent strength. This tells us that confidence in the system is not as strong as it appears on the surface. When both the dollar and bonds show signs of weakness or instability, investors start looking for alternatives. And historically, one of the biggest alternatives has always been gold. Now think about this. We have rising inflation, high oil prices, economic pressure, uncertain policy direction, and unstable market behavior. All these factors together create the perfect environment for a shift in capital. And when capital shifts, it doesn't move slowly forever. At some point, it accelerates. This is why the recent move in gold and silver is so important. It may not just be a short-term bounce. It could be the early stage of a much larger trend, one that is driven by global changes, not just daily news. Now let's go deeper into something most people don't talk about enough, the role of past decisions, especially by central banks, and how those decisions are now shaping today's reality. Because what we are seeing in gold and silver today did not start this week or this month. It has been building for years. Over the past few years, central banks made some very aggressive moves. During times of crisis, instead of allowing the system to correct naturally, they stepped in with massive support. Interest rates were pushed extremely low, and huge amounts of money were injected into the system. This created short-term stability, but it also planted the seeds for long-term problems. When too much money is created in a short period, it does not disappear. It flows into the economy, into assets, into daily life, and eventually, it shows up as inflation. That's exactly what we are dealing with right now. The inflation we are seeing today is not random. It is the result of those past decisions. Now here's the important part. Instead of fully correcting those mistakes, the system is stuck in a difficult position. If central banks try to stay aggressive and keep tightening, they risk damaging the economy even more. But if they try to support the economy again, they risk pushing inflation even higher. This is a trap, and when the system is trapped, it becomes unstable. This instability is exactly what creates opportunities in gold and silver. Because gold is not just another asset, it is a form of protection against uncertainty. When people start losing confidence in policies, currencies, or long-term stability, they naturally move towards assets that hold value over time. Another key issue is government spending. Budget deficits are growing, and governments are spending more than they are earning. This gap has to be filled somehow, and often it leads to more borrowing and more money creation. Over time, this weakens the value of currency. As this process continues, investors begin to realize that holding cash is not as safe as it once seemed. The purchasing power of money slowly declines. And when this realization spreads, demand for real assets like gold and silver increases. We are also seeing a shift in global thinking. More investors, institutions, and even some countries are starting to rethink their reliance on traditional financial systems. There is a growing awareness that diversification is important, not just within stocks or bonds, but across different types of assets. Gold and silver naturally become part of that diversification. Now let's talk about market psychology. Right now, many people are still unsure. Some believe gold has already moved too much. Others are waiting for a bigger drop before entering. This hesitation is normal in the early stages of a trend. In fact, strong trends often begin when most people are still doubtful. The recent drop in gold created fear, but the quick recovery created confusion. And this combination, fear followed by confusion, is exactly what we see before a strong move. Because while the majority hesitates, a smaller group of informed investors starts building positions quietly. This is often called the accumulation phase. During this phase, prices may move up and down, but the overall direction slowly shifts higher. And once this phase is complete, the next move can be fast and powerful. Another interesting signal is how quickly the market recovered after the recent drop. Weak markets do not recover like that. When a market is truly weak, it stays down or continues falling. But when it bounces strongly, it shows underlying strength. So when you combine everything, past policy mistakes, rising inflation, economic pressure, growing deficits, and changing investor behavior, the picture becomes clearer. The system is under strain, and gold and silver are starting to reflect that. This is not about one speech, one event, or one week. This is about a bigger shift that is slowly unfolding. Now let's bring everything together and understand what all of this really means going forward. When you step back and look at the full picture, it becomes clear that the recent move in gold and silver is not just a random spike. It is part of a much bigger shift that has been building for a long time. We are seeing rising inflation, increasing pressure on the global economy, growing government deficits, and a system that is struggling to find balance. Central banks are in a difficult position. Markets are reacting in unusual ways, and investor confidence is slowly changing. All of these signals are pointing in one direction, towards uncertainty in the traditional financial system. And whenever uncertainty increases, the demand for real, reliable assets also increases. Gold and silver have always played that role. They are not dependent on any government. They are not tied to any single policy decision, and they have historically protected value during times of economic stress. That is why, even after temporary drops, they continue to recover and move higher over time. Right now, the market may still move up and down in the short term. There can be pullbacks, reactions to news, or sudden changes in sentiment. But the underlying trend is what matters most. And based on everything we have discussed, that underlying trend is slowly turning stronger for gold and silver. There is also a strong possibility that prices could move significantly higher in the coming period. When markets go through a correction and then stabilize, the next phase is often a powerful rally. And if the conditions we discussed continue, especially inflation staying high and economic pressure increasing, that rally can be much bigger than most people expect. Another important thing to understand is timing. Markets do not move in straight lines, and they do not wait for everyone to be ready. The biggest moves often happen when the majority is still unsure or distracted. That is why awareness and preparation are so important. This does not mean rushing into decisions blindly. It means understanding the bigger picture, staying informed, and being ready when opportunities appear. Gold and silver are not just short-term trades. For many investors, they are part of a long-term strategy to protect wealth and manage risk. As we move forward, keep an eye on key signals: inflation data, central bank actions, economic growth trends, and commodity prices. These factors will continue to shape the direction of the market. But more importantly, watch how gold and silver react to these events. Their behavior will often tell you more than the headlines. If you want to stay updated with simple, clear, and powerful analysis like this, make sure you stay connected with Gold Silver Scope. This channel is focused on helping you understand the real story behind gold and silver, without confusion or unnecessary complexity.